Jim Rickards warns of an impending housing crisis that could surpass the turmoil of 2008. With a massive amount of subprime mortgages and a looming tsunami of student loan defaults, the financial landscape is at risk of collapse. If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. The subprime mortgage bubble. The subprime mortgage bubble was a significant event that shaped the financial landscape. It involved a staggering amount of money. $1 trillion in subprime mortgages were issued. These were loans given to individuals with poor credit histories. Many borrowers did not need to provide proof of income. This created a false sense of security in the housing market. People believed they could buy homes, renovate them, and sell them for a profit. This mindset led to a frenzy. Everyone wanted to get rich quickly, but the reality was different. Default rates on these loans began to rise. Historically, mortgage default rates rarely exceeded 5%. Yet, during the bubble, experts speculated on much higher rates. Some analysts suggested a 20% default rate. This assumption was extreme and unprecedented. A 20% default on $1 trillion would mean a loss of $200 billion. This figure was alarming, but it was only the tip of the iceberg. The real issue lay in the derivatives market, hidden from plain sight. The derivatives dilemma. The derivatives market was vastly larger than the subprime mortgage bubble itself. There were $6 trillion in derivatives. These were complex financial instruments linked to the underlying mortgages. When defaults began to occur, the impact was catastrophic. Many people did not understand how derivatives worked. They were off-balance sheet items. This meant they were not visible on the financial statements of institutions. Investors had to dig into the footnotes to find any mention of these liabilities. The lack of transparency was alarming. As the crisis unfolded, the contagion spread rapidly. Financial institutions were interconnected in ways that few understood. When one institution faltered, others followed. The entire financial system was at risk. The lessons from past crises were ignored. Each new crisis seemed larger than the last. The interventions became more extreme, yet the underlying issues remained unaddressed. Learning from past crises. Learning from past crises is crucial. History often repeats itself, especially in finance. The events of 2008 should have been a wake-up call. Yet, many fail to grasp the severity of the situation. Instead of addressing the root causes, the focus shifted to quick fixes. Each crisis teaches valuable lessons. However, we often overlook these lessons. The financial world is complex and interconnected. When one area falters, it can have a ripple effect. Without understanding this, we are doomed to repeat our mistakes. In the aftermath of the 2008 crisis, many thought they had learned. But new risks emerged. The same reckless behavior resurfaced in different forms. The current financial landscape is filled with hidden dangers. It is essential to remain vigilant and aware of these risks. The unfolding student loan crisis. The student loan crisis is another looming threat. It currently stands at a staggering $1.7 trillion. This figure is alarming and continues to grow. Many students take on significant debt to finance their education. They believe it will lead to better job prospects. However, this is not always the case. When students default, the consequences are severe. The lender often turns to the Treasury for reimbursement. This creates a hidden cost to taxpayers. The losses are not immediately apparent. They accumulate over time, affecting the national deficit. As defaults rise, the financial burden will increase. This crisis is not just a personal issue for borrowers. It impacts the entire economy. The structural deficits will worsen as a result. We are facing a potential tsunami of defaults that could cripple our financial system. The hidden costs of student loans. The hidden costs of student loans are often overlooked. Many borrowers do not fully grasp the long-term implications of their debt. Monthly payments can be overwhelming. They limit financial freedom and hinder future investments. Many graduates struggle to enter the housing market. They cannot afford to buy homes due to their student debt. This in turn affects the overall economy. When young people cannot invest in property, the housing market suffers. Given these factors, a thoughtful approach to investing is crucial. I've found the Interactive Brokers platform to be a valuable resource. You can find it linked below. Go ahead and check it out. Additionally, the psychological burden of debt takes a toll. It affects mental health and overall well-being. Borrowers may feel trapped by their financial obligations. This can lead to a cycle of despair and hopelessness. As the student loan crisis unfolds, the hidden costs will become evident. It is crucial to address these issues before they spiral out of control. The financial landscape is already fragile. We must act now to prevent further damage. Modern monetary theory explained. Modern monetary theory, or MMT, is a new economic paradigm. It challenges traditional views on government spending and debt. According to MMT, countries that control their own currency can spend without the same constraints as households or businesses. This theory argues that as long as a government can issue its own currency, it can always meet its obligations. The idea is that a nation can spend as much as it needs to achieve full employment and economic stability. The underlying belief is that inflation is the only real constraint on spending. Critics, however, raise concerns. They argue that unlimited spending can lead to hyperinflation. They warn that it undermines trust in the currency. The debate continues, with proponents claiming that MMT has been misunderstood. The debt-to-GDP ratio. The debt-to-GDP ratio is a key indicator of a country's economic health. It compares a nation's public debt to its gross domestic product. A ratio over 100% indicates that the debt exceeds the size of the economy. Currently, the United States has a debt-to-GDP ratio of over 105%. This is the highest level since World War II. While some economists see this as alarming, others argue it is manageable. Japan, for instance, has a debt-to-GDP ratio near 250%. Despite this, its economy remains stable. This raises questions about the significance of the ratio. Critics of MMT suggest that high ratios can lead to a loss of confidence in the currency. Japan's economic model. Japan provides a unique case study in economic management. Its high debt levels have not led to the expected crises. Instead, Japan has maintained a stable economy for decades. The Japanese government has embraced low interest rates and quantitative easing. This has allowed it to finance its debt without major consequences. The Bank of Japan actively purchases government bonds. This helps keep interest rates low and supports the economy. However, Japan faces challenges. An aging population and low birth rates threaten long-term growth. These demographic issues could complicate its current model. While Japan has navigated high debt, the future remains uncertain. The psychological boundary of debt. There exists a psychological boundary regarding national debt. This boundary is not easily quantifiable. It reflects how citizens perceive their government's financial stability. When debt levels rise, people begin to worry. They start questioning the government's ability to manage its finances. This can lead to a loss of confidence in the currency. As trust erodes, citizens may seek alternatives. Investors might shift their assets. They could buy gold, real estate, or other tangible assets. This shift can trigger inflationary pressures. Interest rates may rise dramatically as a result. The future of investments. The investment landscape is changing. Economic theories and government policies shape the future. Investors must adapt to these shifts. With the potential for rising inflation, hard assets become attractive. Gold, real estate, and commodities may see increased demand. These assets often retain value during economic instability. Equities may also face volatility. Market reactions to government spending and debt levels can create uncertainty. Investors should remain vigilant. Understanding economic theories like MMT is crucial for making informed decisions. I've been exploring investment options, and Interactive Brokers has been a valuable resource for me. You can find the link to their platform in the first link of the video description if you're interested in learning more. We hope you found this video helpful. If you did, please like and subscribe to our YouTube channel so you don't miss out on future uploads.